Reserve Bank of India's new liquidity framework signals an easier liquidity stance, but only if financial conditions warrant it. Let's discuss the salient points of the framework and the possible reaction in the money market with Professor Ananth Narayan of SPJIMR Institute of Management and Research. You've seen the various points that were highlighted and spoken about, Ananth, and we'll come to each of these individual points in just a bit. But your take on the initial reaction that you would likely see in the bond market because of these announcements.
Yeah, morning, Davina. Look, the market had a lot of expectations from this review. This review is long overdue, by the way. It was promised to us in mid-July. It's been over 2 months now of delay. Essentially, the market was hoping that the RBI would revamp the liquidity framework from what the old dogma was. I think the market will be slightly disappointed by what's come out. In many ways, the report seems to reflect the tension between the old RBI and the new RBI. The old RBI is digging its heels and kind of trying to stick on to the old framework. At the same time, it's given some leeway in terms of the point you mentioned, financial conditions. If financial conditions warrant, then liquidity can be kept surplus, which will give some relief to the market. It also has some elements which are good, better reporting, better use of instruments, etc., which I think are welcome. So all in all, market will probably be slightly disappointed. I think the report reflects a bit of a tension between old RBI and new RBI. Old RBI prevails in terms of the core thinking, but has given leeway for the new RBI to provide relief to the market when required. And it has some elements of new ideas, which I think are good.
Okay, so the fact that the report says that a separate provision of assured liquidity is no longer needed, is that a slight bit of a negative, according to you?
Well, actually, it probably makes sense, Davina. I guess what it suggests is that banks have been relying on both sides, both to borrow as well as to lend funds on the RBI. And because the corridor is so narrow, it's easier for banks to deal with the RBI than with amongst themselves. That's not a healthy practice, and therefore the point the report makes that the RBI should do one net operation wherever possible and allow the markets to kind of deal amongst themselves, I think makes a lot of sense. I'll tell you where the market will be disappointed with this report. Some of the old, if I can call it, dogmas of the RBI continue to persist. One of the points that the market has been making is that liquidity conditions are a powerful adjunct to monetary policy stance. And we've seen this for time immemorial, including now. If you have surplus liquidity, short-term rates tend to come down faster, your CP rates, CD rates, T-bill rates, and therefore eventually deposit rates. On the flip side, if liquidity is persistently deficit, then you do see short-term rates going up, and that transmits into lending rates eventually. Now, one of the asks, therefore, was please acknowledge that liquidity can be a great tool to aid transmission of whatever your monetary policy stance is. This report completely negates that. It continues with the old point that, listen, liquidity is different, your monetary policy stance is different, and by the way, we want to continue with the default mode of keeping liquidity generally in deficit. It says 0.25 to 0.5% of NDTL. Wherever possible, and keeping the repo rate as the operational rate. Second area where it kind of disappoints is it continues to look at the weighted average call rate as the measure of liquidity in the system. Now, market participants, including myself, have long argued that WACR, as they call it, is a very poor measure of liquidity. It's a price measure of a liquidity metric. And irrespective of whether you have 5 lakh crore surplus or 5 lakh crore deficit, your weighted average call rate will be close to the repo rate because of the RBI operations. But there is a big difference in transmission depending on which side of the liquidity spectrum you are in. So that again remains an old dogma, which unfortunately remains uncontested. All of this would have been very disappointing for the market, except for the leeway that you rightly pointed out. If financial conditions so allow, RBI is now allowed to have a surplus liquidity, which the market will read as saying, okay, fine, under the current conditions, the governor has repeatedly assured us he will give us liquidity, and therefore that trend will continue.
Also the fact that they've pointed out that the buildup of large deficit or surplus, if expected to persist, should be offset through open market operation, forex swaps, and long-term repo operations at market rates. Now, was there an expectation to tinker with that, or this was as per now?
Couple of points there, Davina. Look, one expectation was that if the framework allowed for consistent liquidity surpluses, particularly as a means to transmit lower rates into the system as it's doing right now, that would have given far more leeway for the RBI to conduct open market operation purchases of bonds. Remember, at the moment, by and large, liquidity has been in surplus since 1st of June. Now, under liquidity surplus conditions, the RBI will struggle to find a rationale for conducting open market operation purchases of bonds. And whether it's right or wrong, bond markets would like the RBI to purchase those bonds, particularly given the fiscal fears around the government, etc. Now, because the RBI, the policy is not very clear about systemic surpluses, it isn't very clear if OMOs can follow automatically. I think it still might happen eventually, but it isn't entirely justified by this framework. Second point to note is where I agree with the report. The report points out that large open market operations can distort the bond curve. Now, this is something the bond markets will not like to hear, but last year, between July 2018 and June 2019, the RBI purchased 3.5 lakh crore of bonds in the open market operations. That's a massive size, Davina. That's a significant portion of the net borrowing program of the government of India. Now, that obviously impacts bond prices, whether we like it or not. So when RBI says now in this liquidity framework that it should consider long-term repos as an alternative to open market operations, if that recommendation is followed through, we might actually see a reduction in the open market operations conducted and more of term repos being conducted. This will not be good news for bond markets, but personally, I think that is very, very sensible. You should conduct liquidity operations with minimal impact on other markets. Or if you do want the impact, then be cognizant about it and say so upfront. 3.5 lakh crores of open market operations purely for liquidity, ignoring the impact of bond markets, I think is not the right way to go.
So what is the current situation as we stand today? In the last two monetary policies, we've heard the governor talk about daily liquidity surplus, and it's not a small amount. So it seems like we're in a stable liquidity situation, but yet we've over the last few weeks seen the bond yield steepen a lot. Do you feel that, come 4th of October, when we do hear the RBI governor talk again, it could have a material impact on what he has to say?
Again, few quick points, Davina. Look, first off, I think this governor has made it amply clear that he intends to give relief to the system. Financial stability is the word he's used several times, and he's also mentioned he's watching the situation around NBFCs, etc., very carefully. I think, therefore, this current situation of surplus liquidity, which has been on since 1st of June, will continue. I think the governor will be very, very careful to maintain that. To that extent, short-end rates should remain low. At the moment, because of GST outflows, etc., we are seeing a bit of a dip in these surpluses, but I think it will revert back to normal pretty soon. So liquidity stance, I don't think will change. You're right, bond yields have hardened considerably over the last few days. Despite GDP growth coming at 5%, despite assurances that from the RBI that they will keep liquidity and monetary policy easy, I think a couple of reasons for that. One is, given the stretched nature of the overall fiscal deficit, a lot of which is hidden through public sector borrowing, etc., the pressure on borrowing from not just the government of India, but from state governments and from public sector enterprises on the longer end of the curve is significant. And that is, keeping it, the market is therefore struggling to bring down yields when there is so much of borrowing from the government going through in that particular sector. Second, the announcement last Friday of a significant reform, which is the tax rate cut, the corporate tax rate cut, does again bring the fiscal deficit back into focus. The fear is a stretched fiscal balance will reduce the room that the Monetary Policy Committee has to cut rates. And on the other hand, it might lead to eventually higher borrowing program from the government. So that again is causing bond rates to kind of harden up. So it's a bit of a tension that we'll have to deal with. There is fiscal pump priming of the economy or support to the system coming through, and that unfortunately will keep longer end rates elevated. I do think, though, that the MPC will continue with rate cuts. Personally, I expect a 25 basis point rate cut on October 4th. I think the RBI remains very keen that the system be supported, particularly as the financial services ecosystem is largely fragile right now.
Okay, a quick comment then on what your expectation is with regards to the rate cut this time around.
So Davina, look, if you'd asked me last Thursday, I would have said 50 basis points rate cut. This was before the big tax cut announced by the government of India. After Friday, I think we're down now to 25 basis points of rate cut. I still think there are members in the MPC who would be keen on providing larger rate cuts. But particularly with the fiscal question coming up, it might be tough for them to push for anything larger than 25 basis points rate cut. So I think 25 basis points rate cut with an assurance maybe in the press conference that follows, and I'm sure your brethren will be asking the right questions, that liquidity will remain easy for now, notwithstanding whatever this report says. So that point about financial conditions being used as a context to allow for surplus liquidity will continue.
Okay, got that. Ananth, thanks very much for joining us. Really appreciate you taking out the time and speaking with us and dissecting the RBI's liquidity framework with us. Moving on, private banks, they are in fact ready to join the PSU peers at loan melas across 400 districts of the country. Private or public, we are part of one country, one financial system, said Uday Kotak when bankers met Finance Minister Nirmala Sitharaman last evening. But is there enough credit demand for such a loan outreach program to succeed? Let's ask the MD and CEO at Dhanlaxmi Bank, Latha. She joins in right now. Ma'am, thanks very much for taking out the time. First off, your initial reaction to the highlights of last evening's comments that came out, positive to say the least. At least on the liquidity front, the finance minister suggested that there is no crunch. There is ample liquidity in the system. She's not heard one voice that has spoken about any concerns on that front. So your take initially.
Yeah, I agree with what she has said, because there's absolutely no liquidity issues at all for us. There has been substantial liquidity. In fact, we are quite open to giving any kind of loans, and that is the reason we are also having a tie-up with a couple of people for affordable housing loans as well as for the microfinance, which is going on very smoothly in our bank.
Ma'am, this outreach program to 400 districts, obviously, when we spoke to some of your other peers, they said this is just to gauge what kind of loan demand there is, and if there is ample appetite, then depending on the due diligence the banks do, they can give out those loans. So what, according to you, is the demand situation right now?
Madam, there is a lot of demand. As I told you, that's the reason that we are substantially doing a lot of this microfinance activity, affordable housing loans, and smaller loans. See, we are concentrating more on, because our bank being a smaller bank, we don't have an appetite for huge corporate loans, but we do have a lot of appetite for the smaller loans, which is going on very, very smoothly in our bank. And as I said, we are having a tie-up with a few NBFCs also for on-lending, for microfinance, for affordable housing, and even for other products, like any other smaller products which we are wanting to do, like MSME and agri loans at all.
So currently, ma'am, what's the credit offtake of Dhanlaxmi Bank, and with this additional push in this outreach program, is there going to be any considerable difference in terms of?
Yeah, definitely, madam. If you see, even for Dhanlaxmi Bank, when I took charge in the July 18, we had only a credit offtake of 55%. That was our CD ratio is only 55%. Today, in the last 1 year, we have already reached 64%. And going forward, I think in the next 3 to 4 months, we should be able to reach about 68 to 70%. I think there is a substantial leeway available for further growth. And there is a substantial demand in this area also for credit.
Do you feel that, the push to making sure that there are more loans given out and ahead of the festive season, that offtake picks up significantly, that could pose some challenges in terms of the kind of loans that are given out?
I really don't think so, madam, because the reason being that every bank will be doing a proper due diligence. See, as I said, when we are doing on-lending also with the NBFCs, we are doing a lot of due diligence, and most of the people, the branch managers, will be asked to do the due diligence well in advance, so that when we do have this scam, we will be able to really give loans to the genuine people and not just for the sake of giving loans. There is always a possibility in any loan, madam, of about 5 to 10% always going bad, which is not because of the not conducting the due diligence, but for various other circumstantial issues, which will make a loan go bad.
Okay, so in light of that, ma'am, you've said that there is demand and you've seen a pickup in offtake as well to 68% now. By the end of the year, what do you see credit growth at for Dhanlaxmi Bank?
We see the credit growth at around 70%
Okay, all
of
right.
our CD ratio.
Okay, got that. Ma'am, also just one last question with regards to the overall bad loan situation. Have things materially improved? Have you seen, a pickup in resolutions? Have you seen things improving with regards to overall credit quality?
Yeah, definitely, ma'am. There is a lot of improvement as far as the credit quality is concerned. Even in our own bank, we find there's a lot of recovery happening because the customers also feel that once they go to NCLT, they may be even losing their business. So it is better that they come for a one-time settlement with us and then do the adjustment of their loan. And we have been at least successful in having quite a bit of recovery, particularly in this quarter, which will go ahead in reducing our total NPA figures and boost our overall credit portfolio.
Okay, got that. Ma'am, thanks very much for joining us. Ms. Latha, appreciate you taking out the time and speaking with us this morning.
Thank you.
All right, financial companies and infrastructure firms stand to gain the most from corporate tax cuts, says Sayang Mukherjee, the head of research at Nomura. While these two sectors are obvious choices given the expected credit offtake and subsequent construction pickup, he also gives us the brokerage's take on oil and gas, pharma, IT on our series Navigating Through Uncertainty. Here's a small slice of the conversation.
We have a marginal overweight on oil and gas as a sector put together, more biased towards, the gas names. But, I guess, I think your question, is something which is a bit difficult to answer. I do expect a lot of activity on the strategic divestments or disinvestment side, which is an outcome of, let's say, the kind of fiscal slippage that we are likely to see. And it's quite natural to expect that there would be incremental push, and the oil and gas, space would get impacted. Frankly, it's very difficult to kind of, assess as to what would be the nature of these, whether it would be a, privatization or a stake sale, which could have an impact on supply of papers in the market and can therefore have an adverse impact. I think it's a difficult call to say take there, but I feel definitely we will see actions on that space over the next 12 months.
Okay, that's for the oil and gas space. Two particular pockets which have been more defensive in nature, and that's the IT and the pharma space. Obviously, benefit with regards to tax exemptions comes from their productions from SEZ units and the income that they earn from these SEZ units. So probably this kind of a corporate tax may not have a big material impact for these players. So in light of that, do we still focus purely on the earnings potential of IT as well as pharma?
Yeah, you're right. So, I mean, from a tax cut perspective, given that they are already benefiting, but then the fact is that, these benefits are time bound, right? So, as and when these benefits end, they were all supposed to get back to higher tax rates. Now, to that extent, this is a positive. For instance, if you look at the pharma space, most of these companies were taking benefits of higher deductions on the R&D spend. Now that benefit goes away from the next fiscal year. So therefore, you would have seen the tax rates for pharma companies actually going up because of this reason. Now with these tax benefit, the impact may not be as much. In addition, all these companies which have these tax concessions also have to pay minimum alternate tax, the rate for which has also come down. So the cash outflow on paying MATs also, kind of comes down here. So overall, if you see, we don't see in earnings immediately for these companies, but at the end of the day, they also stand to benefit from a medium to long-term perspective. Also, I feel if India follows the policy of an export-led growth, we have to keep our currency competitive. So my sense is that we may not see a significant appreciation in Indian rupee, and to that extent, I feel you may see some support being provided on the currency front for these exporters. Within IT and pharma, we are underweight IT services, given that the stocks have done well and the valuations are high. and you have uncertainties around global growth, which could hurt growth for these companies. On the other hand, on the pharma side, I think there has been a downturn for the last 2-3 years, and the margins are very suppressed. So you may have you may see a non-linear increase, in the earnings in pharma space, and that's where we think pharma makes more sense as an export play compared to IT services.
All right, very interesting insights there from Sayan Mukherjee of Nomura. You can catch the entire conversation on BloombergQuint.com. And with that, it's a wrap on today's edition of Indian Open. Thanks a lot for watching. Up next is the F&O Show.